in case study of certified general accountant. So this is the module 2, strategic, operational and ethical analysis. Within this module, we will see today strategic management for the business, strategic investment analysis, operational analysis, ethical behavior through the organizational planning process. Within this chapter, sometimes in different cases, different types of situation we will face, and that type of situation will come from strategic management within the organization, and also strategic investment analysis. Sometimes we are using the capital budgeting, etc., and for the long-term investment, or also we are sometimes we invest for the short time, for example, working capital management. And operational analysis, is different stages we have, and strategic behavior, that means ethical behavior through the organization planning process. So though we are accountant, that means we need to understand the ethics also. Ethical behavior we have to understand. So first one is strategic management. So what is strategic management? You know it. Strategic management is the planned use of a business resource to reach company goals and objectives. Strategic management require ongoing evaluation of the process and procedure within an organization and external factors that may impact how the company function. Within an organization, external factor that may impact how the company function. The process of strategic management should guide top level, that means program and decision. This is for the senior management team, they use it, and companies of all size in all industries can benefit from the practice of strategic management. So if we look here, this is the strategic objective and analysis. Here, through the short analysis, pastel analysis, we analyze the vision, mission, value of the organization. It is the stage of strategic objective analysis, and also a strategic formulation. We formulate it through the plan and gather resource within there, and also a strategic implementation through the training within the organization with the employees, and the right person should place to the right position, and so training, allocation resource to the employee for effective way use the resource of the organization and get the better benefit from their work. So it is a strategic implementation and evaluation, and next time after evaluating we can correct it. So strategic evaluation and control require all stages. So it is the strategic management. Here we think that the strategic management is the ongoing planning, monitoring, analyzing and assessment of all necessities of organization needs to meet its goal and objectives. We can say that strategic management is the ongoing planning, monitoring, analyzing, assessment and control also. So change in business environment will require organization to constantly assess their strategy for success. Always we have to adopt the change. So what is the benefit of strategic management? So achieving organizational goal takes planning and practice. Strategic management can help companies reach their goal, reach their objective, accomplish their objective. And strategic management ensures the steps necessary to reach a business goal or objective are implemented company-wide. So here we can see that here enhance communication within the organization, that means dialogue, participation, and that participatory management, and also a deeper improved understanding within the organization. What is the goal? What is the mission? What is the vision of the organization? If all employees know that, so that objective can be achieved properly. So, and gather commitment, and also we will get the results. So if we see here, strategic management offers many benefits to companies that use our competitive advantages That means strategic management gives a business an advantage over competitor because its proactive nature means that company will allow be aware of the change in the market. So we need the competitive advantages. This is the benefit of strategic management. Also, achieving the goal is help to achieve the goal. So how will it help? Strategic management helps keep goal achievable by using a clear and dynamic process for formulating steps and implementation, and also sustainable growth. That means growth should be sustainable. So how it is? So strategic management has been shown to lead to more efficient organizational performance, which lead to manageable growth and continue that growth. So that's sustainable growth can be achieved. And also strategic management necessary to communicate and goal implementation company wide, an organization that is working to achieve the goal, It is the objective of the company, and the increased managerial awareness, also the benefit of strategic management. So strategic management means looking towards the company's future. If managers do this consistently, clearly, they will be more aware of the industry trend and challenge. And a town-bound action plan will add with that figure that by implementing a strategic planning and thinking, they will be better prepared for face future challenge for the company, and to achieving the goal of the organization should adopt the effective way that change should be adopted. So how does strategic management work? So strategic management requires setting objective for the company, analyzing the action of the competitors, because every companies, they have the competitors. So review the organizational internal structure, evaluating current strategy and confirming the strategy and implemented company-wide. So process of strategic management is a figure is here. So first have to analyze the current situation, and situation analyze that situation through take the data from internal and external within the organization, internal and within the outside the organization, through the industry, through the market data, etc., for analyzing the survival capacity or market potentiality. Also the market share, how much market share they are doing, that which at this moment is taking another competitor, how much market share they are increase or decrease, etc. Analyze from here and decide on a strategy formulate there. How, which process they will adopt within the organization, and putting a strategy in action, time-bound action plan, a strategy implementation within this stage. Their management issue, organization issue, functional issue, all covered with that. Also, a strategic formulation where that time strategic through the internal, external, corporate, business, competitive strategy, all thing within this strategic formulation. And after formulation the strategy implemented, and that evaluate, change strategy when need, and evaluation and the control always give the feedback. This process of strategic management happen within the organization, within the corporate, etc. So strategic management can be either preemptive and descriptive. And prescriptive strategic management means develop a strategy in advance of the organizational issue. And also, while we see that here, normative management here. So strategic management is a strategy, objective and impact. Each line is stated here. So, and operational management, also we can say that types of strategic management. Different types of strategic management we have. Strategic management as a concept can be approached in a variety of ways. So we can say that type of, also we know it, short analysis is one kind of strategic management. Short analysis we described previous class. And also another thing is balanced scorecard. So balanced scorecard is there. A balanced scorecard helps the company which facts of the business need improvement by the breaking down the performance evaluation process into there are 4 areas, like that means learning and growth, business process, customer perspective, and financial data. The balanced scorecard method can generate a timely report mechanism that show all statistics related to the growth of the company. So it's also a technique also. And also there are 5 steps of strategic management we know. There's first we have to identify, then analyze, then formation and execution, and then evaluation. So here, while there are different approach and framework for strategic management, there are different approach, different schools also. There are generally the same 5 steps is, first we have to identify, then analyze, then formation, then execution and evaluation. Also we can say that stage is that there are, we can say that stage 1, develop a strategic vision and mission for the organization, and setting the objective for the organization, and craft or draft a strategy, achieve objective and vision, or the objective and vision, how we will be achieved it. So formulate the strategy and then implement and execute that strategy, and continue monitor, require and evaluate need and take corrective action. Also need the revise needed. Identification first stage of identification, the management evaluation, the company's current direction. This often include understanding the company's goal, mission, and overall strategic direction, and assigning whether the company's current process will help the organization to achieve its goal. And then analysis in different way, and after that formation, that means formation is, and then execution the plan for achieving the goal, and then evaluate it, continue evaluate, monitor and control within this stage. So this is the that we discuss here. This we can say that the strategic management, how strategic management help to achieve the organization mission, vision, goal, and adding value within the organization. And now we are going for discuss strategic investment analysis is also a vital part. Also that type of thing. You study already ICMA, already CA, that means also capital budgeting chapter also. So here strategic investment analysis within that time. So we know that there are the different types of investment. One is long-term investment, one is short-term investment. So long-term investment is also in the part of capital budgeting. So it is the strategic investment analysis in here, and also short-term is working capital management for the within the 1 year, and more than 1 year is the long-term. So here strategic investment analysis is the process identifying and evaluating capital project, that means project where cash flow to the firm will be received over a period longer than a year. Any corporate decision with an impact of future earning can be examined using capital budgeting framework. So it is the strategic investment analysis within here. So through the strategic capital budgeting framework, we will analyze the long-term, that means investment. So here category of a strategic investment project, there are different types of categories. For example, replacement project to maintain the business, replacement project for cost reduction, expansion project, new product or market development, mandatory project, etc. The strategic investment project. So here, if you see that mutually exclusive proposal sometimes comes here, when acceptance of one proposal implies the automatic rejection of the other proposal, is the mutually exclusive project. For example, A, B, C or X, Y, Z three project. If we take X, then we cannot take Y, Z. And if we take Y, then only Y we can take the other two, that means X and Z reject. And if we take the Z, then X, Y should be reject. So it is a mutually exclusive project. And complementary proposal, when the acceptance of one proposal implies the acceptance of other proposal contemporary to it. Rejection of the one implies rejection of all competitive projects. For example, if we take one A, then we also have to take the B. And if we do not take A, then we do not take B. So this is the competitive proposal. And independent proposal, when the acceptance rejection of one proposal does not affect any of the acceptance rejection of other proposal, so it's called independent proposal. If we take X, so there is no problem for Y or Z, etc. At that time here, sometimes for the mutually or competitive, that times we know there are another capital rationing also. So what is capital rationing? Capital rationing is that if we have the organization the specific amount for investment, and if we we can take 2, 3 or 4 project or 5 project. So within that project, we have to first rank it through based on the cash flow. Also, we can take it as a IRR. We can make the ranking also. Also, we can take as a NPV. Bigger NPV will number 1, the smaller NPV number 2, 3, this way. And also we can use there is a profitability index also. So within that, if we rank and if we take the project, so this where our NPV will be maximized, that group or combination we will take. So through that was the capital is rationing there. So now within this investment analysis, we can say there is one of the vital thing, net present value. You also you did it in your different stage. You did it in your BBA, your MBA or MCOM, and also you did it in your ICMA, also CA. So NPV, we know it, NPV equal to net present cash flow minus outflow. So here, if the NPV positive, we will take it. We will if any project the NPV is positive, so our higher positive NPV, we will take that project also. And negative, we do not take the project. And sometimes we are using the profitability index. So profitability index, also the benefit cost ratio, and desirability factor, present value index also. So profitability index we can calculate this way: PV of cash inflow divided by cash flow of present value outflow. So if PV greater than 1, we should accept it. That 1 means 100%. So if profitability index greater than 1, that project we should take it. And sometimes that means PV equal to 1 is indifference. That means equivalent, no profit, no gain within the middle point. But if P less than 1, that we should not take the project because we are in PV always here, that would be negative. So now there are another technique we use, IRR technique. So it's we know IRR, internal rate of return. So IRR is the discount rate that makes the present value of project estimated cash inflow equal to the present value of the project estimated cash outflow. So IRR is the discount rate that makes the relationship with present value inflow equal to present value outflow. So between that, within middle time, that means IRR, that means NPV here is 0. So with the rate is that is the internal rate of return. And internal rate of return, if more than required rate of return, that project we should accept. That strategic investment we will do, because here required rate of return, if required rate of return is 12%, but IRR is 15%, that we should accept it. And required rate of return 12%, IRR is 11%, we should not accept that project. So this is we know it. So this way, internal rate of return we can calculate. Here is the difference for formulas here. So here, IRR greater than cost of capital, then we should accept it. And IRR less than cost of capital, we reject it. Another one, net profitability index, already we calculate here. And a project NPV, project IRR. So look here. So equity approach. In the equity approach, we discount rate is cost of equity and inflate outflow, equity cash flow, operating cash inflow, cash flow available for the equity, and terminal value of cash. Always will adjust with the tax, replace with the working capital, and then we can calculate NPV, that the pros return for the equity shareholders. And same way, if we total fund approach, this is the equity approach, and this is the total fund approach, overall project approach. So discount rate has cost of 0, equity, that means share capital, that is fund, plus debenture, plus long-term loan, plus preferring share capital, or we can calculate total cost of project. And operating cash inflow, we are using here cash inflow available for the overall project, and terminal cash flow, always value that we will adjust with the tax and release the working capital when it will come. And then NPV, that is the pros return for the companies as a whole. So this both approach we are using, and calculation of project cash flow. Treatment of depreciation is one of vital item. Earning before depreciation, interest and tax minus depreciation multiplied by 1 minus tax rate plus depreciation. This is one formula. It is the project cash flow calculation, and also we can calculate earning before depreciation, interest, tax multiplied by 1 minus tax rate plus tax saving on depreciation. Also we can calculate this way. So here project cash flow, we know it. This is the first, we have to start sale price per unit, and then we will minus from that variable cost per unit, then we will get the contribution per unit. And if we multiply with the contribution per unit, then we will get total contribution. And from the total contribution, if we minus fixed cost, then we will get earning before depreciation, interest and tax. And from that, if we minus depreciation, then we will get earning before interest tax. And from the earning before interest tax, if we minus tax, then we will get net operating profit after tax. And from there, if we again add the depreciation, because it's a non-cash item, so it is really, it is not happening here. So though we are first we minus from the earning before depreciation, interest, tax, and from that we will add it the depreciation because of calculating the cash flow, because it is the not cash item. So after that we will get cash flow after tax. So it is the project cash flow we can calculate this way. Here with that terminal and interest cost, financial cost, we can say this way. Finance cost are already reflect in the project required rate of return, that will whether it was cost of capital, and this show is the interest of long-term items tax saving already considered and with the cost of equity. So terminal working capital, how we'll take terminal working capital, that means last year. Introduction of the working capital is the outflow in the time of in the zero, and release of the working capital in the last, that means a project life, and is also the inflow that time. So working capital should never be adjusted for tax, as it is the balance sheet item. Working capital is also not subject to depreciation, because working capital, we know what is working capital. Working capital is current asset minus current liability. So we know also the current, what is current asset, that within the one of year, that means net cash, inventory, and there are different types of inventory also: material inventory, work in progress inventory, finished goods inventory. All are the part of current asset. So different types of component we know, and that means there are also our debtors, also prepaid, etc. All are the current assets. So we know the treatment of tax and also the setup and also carry forward. So we have to remember, this is the key point. What is the key point? For that type of investment, decisions are based on cash flow, not accounting income. So when we take any strategic analysis, and if we use different types of techniques, but we have to consider is our decision based on the cash flow, not accounting income. So because we know that within the accounting income, there are a few components we are using here, but cash flow is the totally different things. So considering incremental cash flow, the change in cash flow that will occur if the project is undertaken. So sunk cost should not be included in the analysis. So what is the sunk cost? For example, we are using depreciation. For example, we purchase a machine. So that cost is the machine cost, but that cost is the sunk cost. So all just we are using the depreciation, and again when we cash flow consider the cash flow, so that depreciation amount also again we add with that figure, because depreciation is non-cash item. So sunk cost should not be included in the analysis. So these costs are not affected by the accept or reject decision, that is consulting fee paid for the marketing research firm, estimate demand for the new product period, to a decision of the project. So that type of, for example, if we paid a huge amount for the research and development, also that type of cost also here not considered. So combination and cash flow based on the opportunity cost. So opportunity cost should be included in the project cost. The time of the cash flow is important. Cash flow received earlier are worth more than each flow can be received later. Cash flow are analyzed on an after-tax basis. Now, equity cash flow. So we have seen how project cash flow can determine, and here they calculated the equity cash flow. So that have another cash flow here, free cash flow, we will see later. So earning before interest, tax, depreciation and amortization. From there we have to deduct depreciation and amortization, then we will get earning before interest tax, and from the earning before interest tax, if we minus interest, then we will get earning before tax, and from earning before tax, if we minus tax, then we will get profit after tax, and from that we will again add depreciation and then principal repayment of the machine and other things. So equity cash flow is coming this way. And another technique we are using sometimes, modify IRR and also NPV. When cost of capital and reinvestment rate are separated given, then I calculate modified net present value. So this is the formula how we can calculate this one. So modified IRR also, it is the discount rate at which modified NPV is 0. So another thing, our calculation of risks adjusted NPV. So it is also the strategic investment decision. For getting a strategic investment decision, also sometimes we using the risks adjusted NPV. So what is that? So risks adjusted discount rate, there are different methods. If we see here risks adjusted NPV, we can calculate this way. Sometimes certainty equivalent approach we are calculating is, and sometimes risks adjusted discount rate method. So certainty equivalent approach also we can say it C, and that means risks of project would be adjusted with the cash flow, and risks adjusted discount rate, discount of project would be adjusted with the discount rate. What is the difference between both technique? One, within the cash flow we adjust the certainty ratio, that means certainty equivalent point we adjust with the cash flow, but here we only did rate adjustment. So this is the risks adjustment discount rate. So what is that? 1 plus risks adjustment discount rate equal to 1 plus risk free rate multiply 1 plus risk premium. That's a more or less sometimes of CPM formula. And note that we have to remember under this method, project should be discontinued using risk adjusted discount rate rather than the risk free discount rate. And that times project having higher rates should be discounted with the higher rate, and higher the risks of the project, higher should be the discount rate. So here NPV calculated by the using, and we know the risk adjusted NPV. So CB means or coefficient variance. The statistical measurement is the measure of the risks. Higher the CV, higher the risks. So imagine the form that way. So certainty equivalent, another technique that we have discussed here. This is the certainty equivalent. So certainty equivalent coefficient method is that it involves discounting the certain cash flow instead of total cash flow. So there are some steps also. So certainty cash flow equal to cash flow multiply by certainty equivalent point. So this way, and again inflation under the capital budgeting. So here we know there are that type of inflation rate effects is that sometimes is affecting the cash flow and also discount rate and NPV. So how cash flow is doing there? So this is the cash flow. So look here. So real cash flow, it excluded inflation, but money or nominal cash flow, it's include inflation. So what is that? Within this cash flow, two times real cash flow and another is nominal cash flow. So real cash flow exclude the inflation, is the real cash flow, not include in the cash inflation, but nominal cash flow is include inflation. So this is the formula we calculate is conversion of the real cash flow into the money cash flow and the vice versa. So money cash flow equal to real cash flow multiply by 1 plus inflation rate and to the power n. Or we can calculate this way: real cash flow equal to money cash flow divided by 1 plus inflation rate. So if in question give the real cash flow and inflation rate, then we can calculate the money cash flow, nominal cash flow, and give the nominal cash flow and inflation rate, then we can calculate the real cash flow. So discount rate here, conversion of real discount rate into money discount rate, vice versa. So discount rate also this way, real discount rate and nominal discount rate. So real discount rate excluded inflation, nominal discount rate include inflation. And NPV we know is very common to us. So NPV may either be calculated differential by discounting real cash flow by a real discount rate, by discounting money cash flow by money discount rate. Answer in both cases is the same, because if we use the real discount rate or nominal discount rate, the result would be same. Also, if we use the nominal cash flow or discount or nominal cash flow or real cash flow, that answer would be the same. So depreciation is affected by the inflation rate, as depreciation is changed on the book value of the asset and not market value. Okay, so here one is replacement decision. What is this? Replacement decision. So in the replacement decision, whether to replace the existing machine and buy new machine, or whether to repair existing machine, there are differences here. That means life of new machine equal to remaining life of the old machine. We can apply incremental principle. That means new minus old. So initial investment equal to cost of new machine minus salvage value of old machine. This way we can find the initial investment. And again, operating cash flow equal to cash flow after tax from the new machine minus cash flow after tax from the old machine. And terminal cash flow equal to salvage value from the new machine minus salvage value from the old machine. So in the case 2, we can say that life of new machine equivalent or not equivalent remaining life of the old machine. That time we can apply incremental principle, use equation annuity. That time we use it. So there are different stages also. This way we can calculate. And another one, strategic investment analysis. profitability distribution approach also. Here statistical, that means profitability and probability using here. And scenario analysis, which is another thing, scenario analysis, and another decision tree approach and joint probability. Decision tree approach and joint probability. You look here, there are different types. 3 types is here. Number 1, mandatory correlation cache. Decision tree is a graphical presentation of 2 or more than 2 years cash flow, which are dependent on each other. And from here, we have to calculate the joint probability from the both here. Here is a picture is here. So joint probability is the product of 2 or more than 2 dependent probabilities. The total of the joint probability is always equal to the 1. So if you see here, look here, for example, here 40 million is a cash outflow, and first year from this cash outflow can be cash inflow. Here 0.4 probability of 0.4, 25 million will come 0.4, and here 30 million it will come 0.6. So 0.4 plus 0.6 equal to 1. So probability we know 1. So here 25 million may come, its probability is 0.4, and 30 million may come, its probability is 0.6 in the year first. In the year second year, from this 25 million probability, here 0.2%, 0.3 and 0.5 is may become. So here 0.5, 0.3 and 0.2. If we add it, it come 1. Again here 0.4, 0.5, 0.1 is also 1. So here from 12 million it come 0.2. 16 million cash inflow may happen, is the probability is 0.3. 22 million may happen in the year 6, probability is 0.5. Same way 20 million that's cash flow may come in the year second within this parameter. 0.4 probability and 0.5 probability is 25 million and 0.1 is 30 million. So if we multiply this probability with that probability, this will come joint probability. Look here, 0.4 multiplied by 0.2, this will come 0.8. 0.4 multiplied by 0.3, it will come 0.12. And 0.4 multiplied by 0.5, we will get 0.2. Same way 0.6 multiply 0.4, that 0.24. 0.6 multiplied by 5 is the 0.3, the joint. Then 0.6 multiplied by 0.1 is 0.6. If we add all things, this come to 1. So we know all probability, the summation of the probability must be 1. So here joint probability 1. The same way the 25 million is also the 1. Here 30 million also 1. Also in the year 1 also the 1. So this is the here we can calculate the decision tree approach. So another perfect correlated cash flow. This is the perfect correlated. Here is 3 types. It is number 1 type, the correlated, moderately correlated. Moderately correlated is this one, and this one perfectly correlated. Look here. Here cash outflow in the year 0, 25, you can say it million, and in the year 1 is come 0.3, 12, 0.5, 16, 0.2, 22 is the cash flow. So here 0.3, 0.5, 0.2, if we summarize it, there is come 1. So this way in the same figure in 3 years. So here is that calculated here joint probability, estimated NPV is 1, 2, 3, 3, and here 0.3 multiply 1 multiply 1 is come 0.3, 0.5 and 0.2. If we add it, the joint probability is 1. And now another one, it is that Hiller's and Hazard model is a types 3 cash flow. So here independent cash flow and dependent cash flow. So it is the independent cash flow, is the dependent cash flow. Here variance on that is the calculation here. And another one most important thing is that you all do it. All I think in your CA or ICMA you did it. Sensitivity analysis. It is the vital criteria or for selecting specific type project and also calculation of the strategic investment. So sensitivity analysis, also we know what is what if analysis. Here sensitivity analysis is one of the method of analyzing the risks surrounding the capital expenditure decision and estimated the assumption also. And sensitivity analysis is to tools to help the firm analyze change project NPV, and under the analysis we try to measure risks of each factor taking NPV as 0. So here key factor which are used calculation NPV. Here cash inflow. What is this? Okay. Not here. Okay. So cash inflow and inverse if it is decrease, cash outflow increase, discount rate etc. So here some example discount rules. Here there are different types of method, margin of safety approaches here. So here we can calculate this way. Sensitivity is the margin of safety, the change divided by base period multiplied by 100, and also shock approach, percentage fall NPV, revised NPV minus original NPV divided by original NPV multiplied by 100. And again what we said, capital rationing. So capital rationing is the situation under which company is not able to undertake all positive NPV project due to lack of funds. The firm must prioritize capital expenditure and also the which NPV is higher, that type fund they can invest fastly. So maximize the NPV would be there are capital rationing is different project. For example, divisible project and individual project. So divisible project, here the stage of calculating the capital rationing. And the overall beta, asset beta, project beta, farm beta, we can calculate this way. So this is the formula. Situation 1, where 100% equity farm and unlevered farm, that time we can calculate this way. And when debt and equity, that means levered farm, that time then we can calculate this way. And also the overall beta, we can calculate this way. Equity beta plus equity divided by equity plus debt. And within the debt, we have to adjust the tax because debt multiplied by 1 minus tax. And with that, we have to add debt beta multiply debt, again adjust tax, divide by equity plus debt tax. So overall cost of capital or discount rate, we can calculate this way. Sometimes we are using CPFA method, CPFA formula also. So here estimated the project discount rate purely and proxy beta. Here some question and just we are just understanding, and sometimes that type of small problem within the our different situation and different case study also is a part of the case study. So here we can say that certainty equivalent that we already discussed. So a company is considering to take a new project. The management of the company use certainty equivalent. That means they are using certainty equivalent approach to evaluate such types of project. So here the information available for the project, here cash flow after tax, all cash are the same in the 5 years, 1,15,000, and certainty equivalent in the year wise in the first year 0.90 and in the year 5 is 0.65. So project require initial investment of Taka 3 lakh. the company's cost of capital is 12% and the risk-free borrowing rate is 7%. Require advice that company whether it should take the project or not. So if we see here the situation, here look here, very much easy, 5 years, plotting the cash flow after tax, and also certainty equivalent factor here, 3 column from the question, and now we adjusted cash flow after tax. How we adjust here? Cash flow after tax 1,15,000 multiplied by certainty equivalent 0.90, so we'll get 1,03,500. Same way, year 4, 5, we'll get this is. And now the PB factor of 7% here. Look here, the risk-free borrowing rate is 7%. So that 7% from the annuity table, we'll get 7%. Also, we can calculate. We can find this from the calculator. This is the first year 0.935, second year 0.873, third year 0.816, fourth year 0.763, fifth year 7.713. And if we multiply the adjusted cash flow after tax that we adjust with the certainty equivalent, and then we'll multiply with the PB factor of 7% year wise, then we'll get the present value of each and every year. Here the 5 years. Look here, for example, year 3. Here 86,250. If we multiply 0.816, then we'll get 70,380. So this 5 years present value, if we add, the total present value is 3,67,207. And from that, if we initial investment 3 lakh, if we minus, then we will get net present value 67,207. So what would be the answer? Here we can say that since the NPV is positive, project can be accepted. Now another one, look here. This is the probability of establish the cash flow, the capital budgeting. So here is the company considered to start a new project for the which has the gathered from data. Here cash flow, different types of cash flow here, assuming that. And probability is that 30,000 cash flow is probability is 0.1. 60,000 is cash flow probability 0.4. 1,20,000 cash flow is probability is 0.4, and 1,50,000 cash flow may come is probability is 0.1. So from here, the expecting that we have to calculate the expected cash flow from this probability. So here, look here is very much easy. So 4 cash flow may come, and this way here we can less 1 or 2 0. Here probabilities that one. So here expected cash flow is if we see that 900 million or 9,000 million, 9,000. Just multiply 3,000 multiply 0.1, 6,000 multiply 0.6. This way we expected cash flow is calculating here. And if we summarize or adding 4 cash flow, then we'll get cash flow is expected cash flow is 9,000. So it's another one. So another one, look here, it is very carefully. So decision tree technique in capital budgeting.